Bitcoin's dark sides. Since its inception in 2009, Bitcoin has captured the attention of tech enthusiasts and investors with promises of financial freedom, censorship resistance, and decentralization. However, behind these bright promises lie serious risks and dark sides that affect both individuals and society. Below, we explore Bitcoin's major dark sides from technical, economic, legal, and social perspectives. 1. Crime and illegal use. Although Bitcoin operates on a transparent blockchain, it is pseudonymous rather than fully anonymous, which still allows criminals to exploit it. Bitcoin is widely used in darknet markets for drugs, forged documents, and illegal services, as well as in ransomware payments and money laundering processes. Some malicious actors use mixers and cross-chain bridges to obscure transaction traces too. Volatility and speculation. Bitcoin's price is highly volatile. A single tweet, regulatory announcement, or corporate move can dramatically move the price up or down. This speculative nature undermines its claim as a long-term store of value, causing significant losses for many investors. The market is highly sensitive to emotional buy-sell waves and leveraged short-term products. 3. Market manipulation and information asymmetry. Price manipulation, pump and dump schemes, and wash trading occur, especially on smaller exchanges with low liquidity. Whales large BTC holders can influence the market with single moves. Information asymmetry, including access to insider information, algorithmic trading, and OTC volumes, puts ordinary investors at a disadvantage. 4. Security vulnerabilities and theft. While Bitcoin itself is mathematically secure, exchanges and wallets holding private keys are frequent targets. Many centralized exchanges e.g. Mt. Gox, Bitfinex have been hacked, losing millions in BTC. Users are also vulnerable to phishing, malware, and social engineering. Due to the principle of irreversibility, stolen funds are usually unrecoverable. 5. Decentralization myth versus mining concentration. Bitcoin's proof-of-work mechanism theoretically ensures decentralization, but in reality, mining pools and hardware manufacturers create concentration. Dominance by a few pools or hardware suppliers can weaken network security. Geographic concentration of mining also introduces political risks. 6. Environmental impact. Bitcoin mining consumes huge amounts of energy. Mining powered by fossil fuels raises serious environmental concerns. This has led to public backlash and regulatory pressure, with some countries restricting or banning mining. The environmental cost clashes with Bitcoin's sustainability claims. 7. Regulatory risk and uncertainty. Bitcoin's legal status remains unclear worldwide. Some countries embrace it, while others restrict or ban it. Taxation, KYC/AML requirements, and exchange licensing affect investors. Sudden regulatory changes can have significant market impacts. 8. User errors and lost funds. Bitcoin's revolutionary yet harsh rule: if you lose your private key or send funds to the wrong address, the money is usually gone forever. Mistakes in wallet backups and key management can lead to major financial losses. 9. Integration with financial systems and multiplier risks. Institutional adoption brings liquidity and risk sharing, but also systemic risks. The collapse of a major exchange or institutional player can quickly destabilize crypto and derivative markets. Leveraged crypto products can also introduce risks to traditional financial systems. 10. Social impact and inequality. Early adopters and miners captured enormous value, showing that wealth accumulation depends heavily on timing and luck. Differences in tech literacy, capital access, and regulatory knowledge can create inequality. Whether Bitcoin truly democratizes finance is debatable. 11 Psychological traps and community dynamics. The crypto community is full of myths, hype, and FOMO, fear of missing out culture, leading to irrational investment decisions and community polarization. Ideological attachment to Satoshi myths can also weaken critical thinking. 12 Technical risks, software bugs and forks. Bitcoin's protocol is complex and carries potential software risks. Critical bugs, chain errors, or hard forks can create uncertainty. Incompatible code upgrades may divide the community and affect network stability. Practical tips for protection. Distinguish between long-term investment and speculation. Only invest what you can afford to lose. Store private keys in hardware wallets and pay attention to backups and encryption. Avoid keeping all assets on centralized exchanges. Hacks are common. Follow KYC/AML regulations and tax obligations in your country. Avoid making decisions driven by FOMO. Diversify investments. Stay away from suspicious crypto projects, guaranteed returns, and Ponzi schemes. Protect yourself against phishing and cyber attacks. Use two-factor authentication 2FA. Conclusion. Bitcoin is a technological breakthrough and a new financial experiment with enormous potential. Yet, it comes with serious dark sides and risks: criminal use, high volatility, market manipulation, security vulnerabilities, environmental costs, and regulatory uncertainty. The most responsible approach is to recognize both opportunities and dangers and proceed with caution.